Every time we turn around, we hear another member of the Federal Reserve Board yelling about how they're going to defeat inflation. Inflation doesn't care. Members of the Fed seem to want to talk tough. Inflation doesn't care. Members of the Fed want to increase interest rates to drive down inflation. Inflation doesn't care. But you should, because the housing market does care. And so in this monthly market update, I want to talk some more about inflation. I want to talk about some of the other issues that are impacting the housing market right now. I am Justin Miller with the Chong Miller Group. And at the Chong Miller Group, we help people buy and sell homes here in the Las Vegas Valley. This is the November monthly market update for single family houses in the Las Vegas Valley, single family resale houses. Now, before I dive into the numbers, let's talk about inflation, let's talk about interest and what the Federal Reserve Board is doing. And I want to talk about something else as well. Let me preface with, I recorded this video and captured the data on November 5th. Remember, the videos always take data from the month prior. I go into the data set, the multiple listing data set, and I look at what's actually transpired over the prior month. Now, for those of you who've been watching my videos for any period of time, you know I always pull that data on the 7th of the month. That gives me a more stable look at what's actually been going on, because the data set is not completely stable. It's still getting more information in. Some information may be edited out as we go through the early part of any particular month. But I pulled the data for October on the 5th of November. I did that because I want to get this video out to you as quickly as possible. And that's because there's a couple things I want to talk about that are really important. The first thing I want to talk about is with regard to the political environment. Now, if you've not voted, you should go vote. I'm not going to tell you who to vote for. That's up to you. If you think we have insufficient levels of protection for democracy, vote one way. If you think we don't need democracy, vote a different way. If you think that maintaining civil rights is important, you know how to vote. If you think we should not have, or we have too many civil rights, you know how you should vote. You'll vote the way that you want, but I do want to caution you about something that's not really being talked about in the news, that's really important, and it may influence what you want to do in this election cycle. The minority leader for the Republican Party in the House of Representatives, Kevin McCarthy, a representative elected in California, he's declared that he intends to use the debt ceiling to wrest away all of the legislative accomplishments that the Biden administration has managed to achieve over this past year. That's the Inflation Reduction Act, the CHIPS and Science Act, etc. Now, you may or may not agree with those particular pieces of legislation. You may or may not have an opinion about the impact of those particular pieces of legislation. But if Kevin McCarthy, the minority leader, who stands to become the leader, the Speaker of the House, if the Republicans take charge of the House of Representatives, meaning they win 5 more additional seats than what they've had going into this election, Kevin McCarthy has said that he intends to have the Republican Party play with the debt limit. Now, the debt limit seems like this may be an obscure thing, and let me just talk really quickly about what that is. In the United States, unlike most other countries, we have this historical vestige of how debt is taken care of by the government. On the one hand, we get appropriations legislation. Appropriations are sort of permissions to expend money. So something can be appropriated, but it may or may not be budgeted. We also have budgets. The budgets allocate specific dollars to specific programs. Things that get allocated have to be funded through the budget. But we have this third wheel in how fiscal policy is run in the US, and that is the debt limit. Because the government, generally speaking, brings in less money every year than it expends, it incurs debt. It issues treasury bonds, it issues treasury bills, it issues treasury notes, etc., ways to fund the deficit. And we maintain a deficit, and the US has maintained deficits since approximately the Civil War. But those deficits, sometimes they go up, sometimes they go down. To the extent that deficits increase, we have this historically derived artifact of a compromise from generations ago, which was the Congress must vote to authorize the extension of that debt ceiling higher and therefore allow the government to borrow more money. Now, that sounds fine. It sounds like maybe if the government's not allowed to borrow more money, it'll live within its means. There are reasons to think that may not be the case, but there are very specific issues tied to this debt limit. Because the government debt is existing as credit in a credit market, bonds are issued and those bonds charge interest. And so if the government debt hits the debt ceiling, we're not able to pay the interest on that debt. That means that we go into default as a government on all of that debt because we can't pay it. We not only can't pay it off, we cannot pay the interest on that debt. Now, if we got to the point where we cannot pay interest on the debt, that would mean the government has become insolvent, and bonds across the world that are US issued could be called, and suddenly the US government can't pay for anything. What happens? Well, we end up with a debt crisis in this country, but because the US dollar is the reserve currency for the entire world, and US bonds are held by governments and individuals throughout the whole world, there'd be a dramatic immediate ripple effect on the default of US government debt. That would dramatically increase interest rates because interest rates exist as, at least in part, a risk premium. Yes, I'm willing to loan you money, but you're risky. I want to charge you more for that money than I might charge somebody who's less risky. The US government has always maintained a very high level of creditworthiness. And if that were to be breached, interest rates on all US government debt would increase dramatically. That would increase the cost of servicing the existing debt and would therefore either lead to dramatically higher levels of taxes required to collect to be able to pay off those higher interest debts, or would lead to dramatic decreases in the expenditures of the US government on domestic support programs, whether that's Social Security or Medicare or food stamps or military expenditures, foreign aid expenditures, you name it. Any type of US government expenditure that is not debt payment would come under immediate attack, and we would see, in all likelihood, significantly increasing taxes and significantly decreasing ability to fund all of those discretionary programs that the US government funds on a daily basis. Now, would this come to pass? I don't know. But Minority Leader Kevin McCarthy, who's poised to become the Speaker of the House if the Republicans manage to pick up 5 or more seats, has declared that he intends to utilize the debt ceiling to extract from the Biden administration all sorts of concessions that it's very unlikely the Biden administration would ever go along with, or Democrat members of the Congress would ever go along with, which means there's a very high risk that for the first time in history, the US government could actually be placed into default on its government debt. So I want you to know that this is literally existential as related to the government of the US. You say, well, how could the government possibly go out of business? Well, it happens. If we look back to the early 1990s, the Soviet Union went out of business, right? It does not exist any longer. We have the vestigial pieces of the Soviet Union in Russia and in several other places, including Ukraine. This is a mess that really could materialize and metastasize into a massive world problem. This is not something that sane people would play with, but Kevin McCarthy, the presumptive Speaker of the House, has said this is exactly where he intends to go. The Democrats, if they lose in this election, have very little possibility of overcoming this problem. There's a small window of opportunity perhaps in December, but that requires agreement from Republicans in the US Senate to be able to accomplish that. We'll see what happens with this issue, but keep in mind how you vote in this election could really have significant economic consequences and geopolitical consequences that are of a catastrophic nature. All right, now having said that, let's talk about the Fed and interest rates and what they're doing. The Federal Reserve, earlier this same week that I'm recording this, just increased the Fed funds rate again by another 75 basis points. This is a fourth increase this year of 75 basis points, with additional increases having taken place earlier in the year that were a little bit smaller. Now, this particular increase that they engaged in not only was large, 75 basis point increase is actually historically pretty large, but it also took place at the beginning of November in an election year. Very interesting, because the Fed historically has always not acted to increase or decrease interest rates once within about a 1 month window of an election. Apparently, it's so important for the Fed this time to talk tough to inflation that they decided, we don't care about that history, we're increasing interest rates, and we're doing it at a very steep 75 basis points, less than 1 week before an election. Wow. Inflation must really pay attention to the tough talk coming from the Fed. But inflation doesn't care. Inflation's a thing. It doesn't listen to what the Fed wants it to listen to. Inflation is determined by levels of demand in the economy and levels of supply in the economy. And there's no two ways around that. So all the Fed is really trying to do is decrease demand in the economy by making the price of money so expensive that people cannot afford to go out and buy things on credit cards. People cannot afford to engage in other types of demand-related activity that the US economy relies on. If people cannot afford those things, demand drops off. Consequently, prices come down, trying to find a price at which people will actually still demand things, and therefore inflation is lower. Well, I've spent several minutes in videos over the past multiple months talking about what the Federal Reserve is doing and how it's making mistakes. So is the Federal Reserve this infallible group of academic economists that hold government jobs? No. Do they make mistakes? Absolutely, including catastrophic mistakes. Can the Fed induce a recession? There's no question. The Federal Reserve has, purely within its power, the ability to tighten monetary policy to a level that induces a recession. Most US recessions have been induced accidentally by the Fed tightening monetary policy too far. Sometimes the Fed has acted very deliberately. In the 1970s, former Chairman Paul Volcker decided he wanted to induce a recession to get rid of very ingrained inflationary forces that were in the economy. He did, and we experienced a really bad recession with unemployment actually going over 10%. Well, if the Fed can induce a recession, because it's within its power, should it induce a recession? And is it intentionally the appropriate thing to do right now? Well, one of the interesting things when we talk about the Fed, about the mistakes that the Fed is capable of making and the impacts of those mistakes, is let's look back to the financial crisis. The financial crisis, 2008 to 2011, experienced here in Las Vegas is and called a housing crisis, starting in 2006 and going through 2012. Throughout the country, this was actually not a housing crisis, although it manifested itself partly in the housing market. This was actually a financial crisis, and it was caused by the Fed. So here's what happened. Lending standards were very loose in the early 2000s, meaning most anybody who wanted to buy a house could simply qualify to buy a house. What this meant was people could get into a mortgage very easily and at very low teaser level rates. Those mortgages, however, would reset. The teaser rate would disappear. So let's say a teaser rate was 1% for the first 2 years, and then the mortgage resets. Well, the regulations for adjustable rate mortgages at that time were considerably looser than what they are today. And so resets could be really consequentially significant. But banks were not concerned about the ability for a borrower to repay. Why? Well, a variety of reasons, but one of the reasons was housing prices were going up, and they were going up at a fairly quick clip. And what that meant was people could refinance their house. And so somebody goes out and they find a $110,000 house. They buy it with an adjustable rate mortgage with a teaser rate. They're making small payments on that. And 2 years out, that house is worth $160,000. So somebody who's going to have a mortgage rate reset instead refinances that property, taking out a new mortgage with an adjustable rate that's got a teaser rate in front. No problem. The original mortgage is paid off. And so there's no problem there. As long as prices continued to go up, that would allow for resets to be avoided on existing loans because people could just simply refinance. And so the banks looked at this as a fantastic revenue generator because one, they could write lots of loans, and then two, people would refinance those loans. And when you take out a loan, you're having to pay bank fees for the issuance of that loan. So banks don't just make money on the interest rate, they make money on the processing charges and on all of the other fees required to get into a loan. So the banks felt they had made this money minting process, and lending standards were very low. I'm going to show you a chart of that in a little bit about the relative level of lending standards, the difficulty of actually getting a loan. It's pretty interesting. But so in 2006, the Federal Reserve had become concerned that economic activity was maybe accelerating at too quick a pace. And so they started to raise interest rates. Now, in reality, this was coming off of a recession in 2001. You remember 9/11? We went into a very quick, short recession, and there was a lot of concern about how much travel people would engage in after 9/11. There was very high level of concern about how much other kinds of activity where people would congregate together, whether it was at concerts or movies or sports stadiums, might take place. And that was putting a dampening effect on the level of economic activity. And so the Federal Reserve decided immediately after 9/11 to cut interest rates significantly to support the economy. Probably a really good idea, but the Fed left those interest rates really low for too long a period of time. And what it did is it led to a lot of speculation in the potential price appreciation of different assets. And so we started seeing a lot of asset pricing going up very quickly because the Federal Reserve had made regular savings worthless. If the banks are not earning interest, they're not paying interest to depositors. And so money that would normally have been sitting in savings or maybe being expended was going into buying various assets. And that was causing asset prices to go up, including the price of houses. And housing costs were going higher. Well, because the Fed waited too long to intervene, in 2006, when they started to increase interest rates, that started to have an impact on the housing market that by 2007 was starting to materialize into other parts of the US economy. We started to see oil prices drop off dramatically, and that was causing some dislocation in the hedge fund industry, with several hedge funds that were heavily invested in oil companies and pipeline companies suddenly going bankrupt. By the beginning of 2008, we saw Bear Stearns, an old investment bank in New York City, come under such level of pressure that the Federal Reserve effectively helped Bear Stearns be placed into receivership and its assets distributed and its liabilities distributed through the investment banking community in New York. But the Federal Reserve decided, oh, everything's fine, no problems here. And we get to October of 2008 and we run into a really big problem. One of the largest investment banks in the world, Lehman Brothers, finds itself on the wrong side of several very consequential trades that had been really dramatically impacted by increasing levels of interest rates and the impact of those increasing levels of interest rates on housing mortgages and on certain other types of bonds. And the Federal Reserve, who is responsible for maintaining the viability of the banking system, decided to let Lehman Brothers fail. And within one day of Lehman Brothers failing, this large investment bank, the entire US economy seized up. Now, you might say, is Justin making this up? You might ask how I know these things. Remember, I was doing my PhD at the time in New York City. I was studying entrepreneurial finance. I was studying business at NYU at Stern School of Business. And my dissertation research was actually on private money in hedge funds. And it was actually at the Federal Reserve the day Lehman Brothers failed. I was there to interview one of the members of the Fed. In fact, the only member of the Fed who had any knowledge about the hedge fund industry. And after about 10 minutes of that meeting, the guy stands up. He says, Justin, can we meet again next week, next Tuesday? We'll be perfectly fine. We have a crisis situation here, and I need to do something else. And so I laughed at him. I said, next Tuesday is the Federal Open Market Committee meeting, the FOMC meeting. And he said, oh, that's easy. We do those all the time. Right? That's the meeting at which the Fed governors decide whether to increase or decrease the Fed funds rate. So it's a really consequential meeting that takes place 10 times a year, but that was an easy day relative to what took place with the collapse of Lehman Brothers. The collapse of Lehman Brothers froze credit throughout the entire economy. Without credit, the US economy does not work. That collapse of Lehman Brothers created a housing crisis in Las Vegas that was so deep that we saw prices going down by approximately 60% and took years to overcome. And in fact, we did not get back to that pre-crisis level of housing on an inflation-adjusted basis until this year, 2020. We saw housing prices dropping significantly, not like in Las Vegas or in Phoenix, but significantly all around the country for the only time in U.S. history where we've seen significant movement in housing prices, which is seen to be correlated all across the country. Housing prices are set at the local level with local demand and local supply. But because there was no money that people could borrow, demand all across the country for housing dried up. For vehicles, dried up. You may remember General Motors had to be bailed out by the US government. Chrysler had to be bailed out, ended up being bought by a company in a different nation. Ford had managed to take out a whole lot of debt prior to the collapse in October of 2008 and managed to use that debt to avoid bankruptcy. Insurance companies all across the country were going broke. We had a really, really significant financial crisis, and it was precipitated specifically by the actions and subsequent inactions of the US Federal Reserve. The Fed can make mistakes, and when they make mistakes, they can have massive impacts throughout the entire system of the US economy. What's the Fed doing right now, and why is it making a mistake? Because inflation can arise on the demand side, inflation can arise on the supply side, and increasing interest rates does nothing to help spur supply. In fact, it actually constrains supply, meaning that increasing interest rates acts against decreasing inflation levels. Also, the Federal Reserve's actions of stating they're looking for 2% inflation are so decontextualized from the larger demographic growth characteristics of the US economy that they're bound and determined to fight something that they don't have the capacity to fight. What do I mean by that? The US population goes through a cyclical period associated with generational growth. Some generations, like the baby boomers, are larger than other generations, like the X generation. Well, the millennials are the largest generation of Americans since the baby boomers, and in fact are actually larger numerically than the baby boomers. When the baby boomers were moving into their prime spending years in the 1970s, that's when we started to see secular increases in inflation and increases and increases and increases until Paul Volcker came into the Fed and said, we're getting rid of this. Well, timing, demographic timing, worked fortuitously for Paul Volcker. He starts increasing interest rates to drive down demand at the same time that generational demand started to fall off from the baby boomers. So those were working in concert with each other. And so he didn't have to drive interest rates quite as far as he might have otherwise, and the impact was maybe less on unemployment than it would have been otherwise. Nonetheless, we had interest rates that were in the 18% range. We had unemployment that was over 10%. Well, we're in another generational cycle right now. We're in the millennial-associated generational cycle. Millennials started coming into their prime spending years last year in 2021. And so what the Fed is doing right now is actually fighting the demographical trends that exist within the larger US environment. They're trying to get millennials to stop spending in some manner of analysis at the same time that millennials are entering their prime spending years, buying houses, buying cars, starting families. What this means is that we have built-in demand in this economy that's going to be astoundingly hard for the Federal Reserve to constrain. In 10 years, sure, but we're in a relatively high inflation period. It's not really possible to drive inflation down. Now, this works on the other side as well. Population in Japan has been declining since 1990. Japan was going to be the country that would rival the US if you listen to the news through the 1980s. The Nikkei, the stock index in Japan, peaked on December 31st, 1989. And subsequently, it started crashing and crashing and crashing, and has never gotten back to the level that it achieved in December of 1989. Throughout the 90s, throughout the 2000s, throughout the 2010s, and now into the 2020s, the Bank of Japan, Japan's equivalent of the US Federal Reserve, has been doing everything it possibly can to stimulate the Japanese economy. And the Japanese government has been doing everything it can to expend money beyond the level of money that it takes in taxes, to build infrastructure, to pay people money, to do anything to expand the economy. Inflation in Japan since 1990, right now I believe it's at its peak, post-1990 peak, at 3.1%. The Japanese government is unable to induce inflation in Japan because of the demographic trends, which are Japan's population keeps shrinking. And a shrinking population demands less and less every year. So can the Federal Reserve successfully fight demographic trends? Not well. They can create catastrophic environments and make great big mistakes like they did with Lehman Brothers. But short of doing something like that, which is not really solving any problems, right? It's just replacing one problem with a massive other problem. Now, am I saying that the Federal Reserve is going to get to that point? No, but I don't know. Monetary policy tends to work with significant lags of unknown duration, but 6 to 12 months generally. The Federal Reserve has increased the Fed funds rate from 0 to now 4% during the course of 2022. And they're not waiting around to hear whether or not the economy is slowing down. We know the economy is slowing down. Now, interestingly, unemployment has not started to tick up. We just got the October unemployment report on Friday of this past week, so yesterday. And that actually showed over 260,000 employees were added to the economy over this past month, even though interest rates are going up, even though economic activity is slowing down and perhaps contracting as it did in the first 6 months of this year. Why is the unemployment number not responding? Why is the employment market not responding the way the Fed thinks that it should respond? Well, there's a variety of reasons, including an understanding of demographic growth that's taking place that's causing some level of resiliency in demand, as well as we're coming off in Las Vegas a period where we'd had over 33% unemployment and companies having a really hard time fully staffing up to engage even the level of demand that we have now. And so they're not wanting to let employees leave. They're wanting to hold on to employees, and they're wanting to continue to backfill those slots that had been desperately required to be filled. And so we're seeing tremendous strength actually in the employment market. Now that in and of itself is challenging, and recessions can actually start with levels of unemployment that are too low to be able to sustain economic growth, which is an interesting thing in and of itself, but for another video. So what does that mean looking forward as related to the housing market? It means we have a Fed which is doing everything it can to slow the economy. And they're doing that in a way which the housing market is very sensitive to, which is they're increasing interest rates. And increasing interest rates make it more expensive to buy the same property. And that means the housing market is being impacted by what the Federal Reserve is doing. Well, how's the housing market being impacted? Well, let's go ahead and take a look now. These are the numbers for the month of October for resale single-family homes in the Las Vegas Valley. Now, the first number we always look at is price. And of course, we've been hearing all over the place about how prices are crashing, how we're way, way down. So let's update that. In October, prices came down $5,000 from where they had been in September. They came down from $440,000 to $435,000. That's at the median resale single family home. Now, when you hear the data coming out of the Las Vegas realtors and parroted in the newspapers and everywhere else, that number is going to be $440,000 because LVR and others inappropriately do not take out those houses which are not actually resale that make it into the MLS data set. So the correct number is 435. It's down 5,000 from the 440 last month. So we're down 1.1%. Now, interestingly, we're still up from the year before period. So October of 2021, we saw pricing, median price, $410,000. So we're up $25,000 from where we were 1 year ago. That means we're up 6.1% year over year. So same month prior year to same month this year. And while the number of residual months remaining, if we look at year to date where we were January 1st of 2022 relative to where we are today at the beginning of November, we are up $10,000 from 425. So we are up 2.6% year to date still. Housing prices are not collapsing. By the end of this year, we may be back to where we were at the very beginning of the year. Right? We might be in a totally flat pricing year. Right now, we're up 2.6% year to date, and we're up 6.1% from 12 months ago. If that's what crashing means, we should be crashing all the time. These prices are not problematic. If you bought earlier this year, you might be down just slightly, but actually, according to the Mortgage Bankers Association, kind of interestingly, Americans have a near record level of equity in their houses right now. Now, why is it near record level? Because the record level came earlier this year in May as prices were peaking. So equity levels have come down just slightly, but the number of people who bought their houses at a price above where we are right now is very few all across the country because prices are just slightly down from where they were at their peak. Interestingly, because mortgage lending standards require generally people to put 15% into a loan in order to avoid having to buy mortgage insurance, people who bought in May at that very peak, they still have equity in their home, right? People are not underwater on their mortgages. We are down $45,000 from the $480,000 that we achieved at the end of May, which means we're down about a little more than 9% from the absolute peak. People still have, even if they bought this year, equity in their homes. Now, you could buy a property with as little as 5% down, with an FHA loan as little as 3.5%, but let's just say a conventional loan, 5% down, but you're paying a mortgage insurance to do that. Sometimes you're able to avoid mortgage insurance with a 10% down. So if you got in with the minimal sort of 10% down, no mortgage insurance, you still have some equity left in your home. You're not in a bad shape right now. You're not going to be in a bad shape. Prices have remained really stable. Yes, prices have corrected some since May. They'll likely continue to correct some as we go forward in time. Remember, we have seasonal downturn in level of activity every year around the holidays. That means November and December activity will be slower than what we'd seen in October. Historically, exactly normal pattern. In fact, January tends to be the slowest number of closes that take place in a year because closes tend to take place a month after something goes into contract. People are not looking for houses in December, therefore closings are slower in January than they are any other month during the year. So let's talk a little bit more about what that means. And I want to talk about it with regard to price per foot. I also want to talk about it with regard to sales volume. I'm Justin Miller with the Chong Miller Group. I produce these videos to put valuable real estate information into the public domain. If you find these videos to be interesting, helpful, or have usable content, please subscribe to our YouTube channel. And as they say in the YouTube universe, please smash the like button. That way I'll know to continue to produce videos like this. Thank you. And now back to our show. And I want to show you a couple interesting charts. But first, price per foot. Price per foot, $243. This is down 1.2% at the median from the $246 that we had achieved in September. So we're down 1.1% on median sale price. We're down 1.2% on median per square foot price. So pretty close to in line. It means that the market, to the extent that it's suffering, is suffering pretty equally across all price strata right now, which is interesting. On a year-over-year basis, so from October of 2021, we're up 7.0% from 227 per foot in October to October. That's on the price per foot. That compares to up 6.1% median sale price. So again, pretty stable across the different pricing strata for what's taking place in the market right now. To the extent we're seeing slowdown, it's approximately equal across all of the different segments of the single-family housing market in Las Vegas right now. So what about sold? And this is where the numbers start to become really interesting. And so I want to show you a chart. Now, a lot of people talk about how, especially in Las Vegas, the market is incredibly volatile. That they then state prices go up, prices go down. It's really volatile. Now, the suggestion in that is maybe you can time the market. You wait, it's gone up, you wait, it comes down, you get in at that lower price point, and you'll be able to ride the next wave up. In the stock market, volatility is actually largely associated with pricing. That's not true in the housing market, and it's definitely not true in the housing market here in Las Vegas. The Las Vegas housing market is very volatile, as you can see in this chart. But this is a volume chart. This is the number of houses that have sold during any particular month over the past 10 years. You'll notice that there's a significant dip every year. Those are taking place in January. That's where I said you get this seasonal slowdown every year, that we get these low numbers in January. Things tend to be strongest in the late spring. But we've got this sawtooth pattern that shows really significant volatility in the number of sales. Well, let's contrast that. We'll talk more about sales in just a minute, but let's contrast that with this chart. This is pricing across that same 10-year period of time in Las Vegas. This does not look like volatility. This looks like prices go up on a trend line, and we get fluctuations around that trend line. Sometimes prices go up a little more strongly. Sometimes prices go down a little bit. Now, this version of the chart, the exact same chart, but I've included that downturn since May. And you can see we've had some downturn since May. Interestingly, however, it's a small downturn. We are not experiencing significant pricing volatility. And actually, if we were to think, what if we actually had bought a property in 2019 before the pandemic? Or what if we bought a property at the very lowest price point for single-family residences in the pandemic-associated collapse that obviously never came? We would be up at the median from something approximately $300,000. Most of 2019 was priced sort of $297 to $305, a little bit of fluctuation in there. The bottom price at the pandemic shutdown of the economy was 303. So let's just say we had bought at 300,000. We're up $135,000 at the median from that, from the prices of 2019, from the price at the bottom of the pandemic shutdown in 2020. And when I say we're up $135,000, I mean to where we are at the end of October, $435,000. That means we're up over 45% over that 2-year period of time to where we are right now. Yeah, we had been higher. We'd gotten to 480 in May, at the end of May. And we've given back $45,000 of that. People are not losing money in this market. Prices are not collapsing in this market. There is no crash taking place in this market. People are making money in this real estate market. But let's turn our attention to sold volume now. If you need to sell, this is a challenging market in which to sell because not much is actually selling. The number of closed sales, single family residential resale, Las Vegas Valley, October of 2022, 1,573. Now that's an interesting number, right? That number is below the pandemic low. When the entire economy was shut down, there were more houses that traded hands than traded hands in October of this year. And remember, October is not the slow month of the year. Historically, seasonally, we've got to get through November. We've got to get through December. We have to get through January. Sales are trending down. They're trending down pretty steeply, as you saw on that volatility chart, meaning the volume chart, the one that showed that very steep sawtooth pattern. We are plumbing historically low volume levels now, right? We'd been way below where we were last year. Last year was record volume year. This year, we have now entered into record low volume year. You've got to go back more than 10 years when the population of the Las Vegas Valley was considerably less than it is now to find volume levels that are lower than this, because this is the lowest in 10 years, as you can see on the 10-year chart. This is actually the lowest volume since January of 2009. That's how low this volume is. It's slow out there. It really is. We are down 14.3% from the 1,836 houses that traded hands in September, and we are down 47.9%, kind of irrelevantly, from the 3,019 that traded hands last October. Last October was an unusual year. This year is unusual. It doesn't matter in this regard, in these numbers, how we look relative to the year. What matters is we are now at 13-year lows on volume. And we're going to get slower through the remainder of this year. Now, how do I know we're going to get slower? Maybe we just have this aberrant October. Well, let's look at pendings. Remember, pending home sales are contracts that were written during the month. They have not yet closed, and therefore we expect them to close in the following month. And therefore, they're forward-looking. Pending home sales in October, 1,500. That's lower than the number that's sold in October. It's down 11.1% from the 1,687 that were pending in September. It is down 52.7% from the 3,172 that were pending in October of 2021. And by the way, we always hope that most of those pending contracts do close in that following month. But we see a drop off because some houses drop out of contract. We'll talk more about that in just a minute. But that means that we're going to see, in all likelihood, below 1,500 houses sold in the month of November in the Las Vegas Valley. It's very, very weak volume numbers in the housing market right now. There's one other thing that I want to point out, and that is the availability of mortgage money, because this also impacts the level of sales that take place in the market. Now, in this chart, comes from the Mortgage Bankers Association, you'll see that we have a scale for the effectively the ease with which people can borrow money on a mortgage. And you'll see that we've been hanging out at the level that we had about 110, 112 on this particular scale. But look what happened back in that 2006 timeframe and the couple years prior to it. We had availability, ease of access to mortgage money that was up to 900. Money had never been more easily available than it was at that time just prior to the housing market collapsing. So we had teaser rate loans with extremely available funding, meaning that we had people who probably never should have been taking out loans who were taking out loans. Do we have that kind of thing now? No. We have the highest level of homeowner equity that we've ever seen. While adjustable rate mortgages are becoming more common over this past month or two, actually the spread has just become big enough between the 5/1 ARM and a fixed rate 30-year mortgage that it makes sense to start looking at those adjustable rate mortgages. So we have single-digit percentage of homeowners in adjustable rate mortgages right now. And most of those people have positive equity in their homes. We're not anything like where we were with 62% of people underwater on teaser adjustable rate loans that we saw in 2006. This market is not going to be flooded with foreclosures. It's not going to be flooded with short sales. It's not going to be flooded with people needing to get out of their properties. It's not going to be flooded with inventory. People who own property, unless they really need to sell because maybe they've been transferred to a different location or have some particular life event. Most people are not listing their properties right now, and we're seeing properties coming out of the market, not because of sales, but because withdrawals are higher and expireds are higher. And that's putting a flooring under pricing. No flooring under volume volatility. And we're going to see that drop off. I don't know how low that's going to go, but we could see volume way down from where we are right now at the end of October before we get through January's numbers. But it's interesting looking then at that pricing data. That pricing data is not showing collapse. Volume way down. No question about it. Way down from normal. Not just way down from the record levels last year, way down from normal. And housing prices are holding up. Well, why is that? Well, maybe part of it is because there's actually not that many houses for sale. For sale units, single family resale in the Las Vegas Valley, 8,075 last month. That's down. It's down 6.9% from the 8,681 houses sitting in inventory in September. So that's interesting. This is actually the third month where we've seen decreasing inventory. So we now have a trend in place that inventory, for sale inventory, is going down. We see this as well with new listings. New listings peaked in May, and we've got a solid downtrend in new listings in this market. 2,776 newly listed resale homes in the Las Vegas Valley in October of 2022 2022. That's down 17.3% from the 3,357 listed for sale in September of 2022, and is down 23.7% from the 3,639 that were listed for sale in October of 2021. So we have inventory that's actually only about 80% of normal, and inventory is coming down, and new listings are coming down. Expired listings, withdrawn listings, those are up considerably. Expired listings are listings that went into the MLS, they go in for a period of time, and they did not sell, and they simply expired and disappeared from the market. Withdrawn listings are ones where either a seller or an agent, more usually both, have decided for various reasons, you know what, we don't want to sell any longer, and they withdraw their listing from the multiple listing service. Those numbers are up. Right? Last year, almost nothing was expiring because everything was getting multiple offers within very short periods of time. Very little was being withdrawn for the same reason. Why bother withdrawing from the market if you're getting these great offers, lots of them competing against each other to buy your property? It's not the market we're in right now. We are in a very slow market. Some people are calling this a buyer's market. Actually, inventory is down. And buyers they've got more choices and they can take time, but I would not refer to this as a buyer's market. This is a challenged market associated with both low levels of supply, 80% of normal, low levels of demand, low levels of seller interest, and high levels of interest rates. We're going to talk more about interest rates in just a minute. First, I want to talk about this one other data point that I've been giving you every month for the past approximately a year now, and that is back on market. Remember, houses go into contract. They become pending home sales when a buyer and seller negotiate and sign that residential purchase agreement. Most of those are going to actually close, but some number will simply fall out of contract and the property will come back into the market. They fall out of contract because of a variety of reasons. Seller gets cold feet, buyer gets cold feet, appraisals make a deal impossible, inspections that are not being handled appropriately by buyers requesting the moon or sellers saying they're not going to do anything. There's a variety of reasons, and highly elevated on that list for a whole more than a year now actually has been bad appraisals, but that continues. I've been saying back on market would be trending down a little bit. So back on market, single family resale residential in October, 773. That meant 32.9% of contracts that were entered into failed, and the property came back on the market. It's actually up just slightly. It's up from 31.8% in September. I think that we're starting to see some additional appraisal problems because appraisers are hearing prices are collapsing and they're marking appraisals as downward pricing trend when that's actually not what's taking place. Prices are stable. We're up year over year. We're up year to date. We're down just slightly from the top. And so appraisers have the ability to mess up deals. But of course, as interest rates go up, we do have some buyers who simply no longer qualify for the loan that they thought they'd be able to get. And so that's pulling some deals apart. We have some buyers who are becoming very scared. Oh, our price is going to collapse. I keep hearing prices are collapsing. Maybe I should pull back and cancel my contract. And of course, some sellers are realizing that they're going to be paying a lot more on a mortgage in a replacement property. And so some sellers are actually thinking, you know what, maybe now is not the time. Let's wait. Let's wait through the holiday season. Let's wait through the election season. Let's wait for some level of stability. Generally speaking, I don't believe in waiting or trying to time the market, but I will tell you in this market right now, being a seller, super challenging because there are very few buyers out there. And so you've really got to think about how long you're willing to sit in the market, especially over the holiday season when you want to be preparing for holidays and having guests over and cooking and whatever else. And, do you want people traipsing through your home at that time? So if you need to sell, find a real estate agent and sell your property. But if you don't need to sell, this is not necessarily a great time to do it. Now, during the pandemic, I had suggested, when almost everybody else was saying prices are going to be coming down, prices are going to be dropping, we're going to see collapse in the housing market, I was saying prices will be going up because demand remains strong and in place, even though people are locked at home. I also said we'll see how quickly prices go up based on whether buyers or sellers return to the market first, and that I suspected it'd be buyers coming back before sellers. I suspect the same thing is going to happen this time. I think we're going to see inventory continue to drop off, new listings continue to drop off, and when sellers start returning to the market, they're going to be returning to the market in smaller numbers than buyers. I think as soon as the Federal Reserve stops increasing interest rates, without even lowering rates, I think once they stop increasing interest rates, I think that's going to give buyers some level of certainty about how the future looks, and that'll pull buyers back into the market more quickly than sellers return to the market. And I think that that's going to turn prices around from the minor correction that we've been having and push prices higher again. If you're waiting because you think you're going to get all those prices that happened in the 10 years prior, as you saw on that graph, you're deluding yourself. That's not going to happen. We're not having a pricing crash. We're not going to have a pricing crash in this economy, in this market, in this demographic growth time associated with generational patterns and associated with the overall growth of the Las Vegas Valley. It's not happening. Prices are not weak in the sense that they're not collapsing. Now, there's one other note that I want to make with regard to the impact of housing prices and interest rates, and that is with regard to affordability. So if you've been watching my videos, I've mentioned a number of times in the prior cycle, before the Fed decided to butcher the economy with its horrible error of allowing Lehman Brothers to fail, housing prices in Las Vegas had reached, through single-family resale residential, had reached $314,700. And on an inflation-adjusted basis, that's $448,000. And so if we take that inflation-adjusted number for the median, 448, and we apply to that, that's June 2006, we apply to that the interest rate that existed on average in the economy for 30-year residential mortgages at that time, non-variable rate, right? Fixed rate 30-year mortgages. And we put that onto a 90% loan-to-value loan on that median house. That meant that people were paying $2,595 per month. Average loan, median home, 90% loan-to-value loan. Now, at the peak of this cycle in May of 2022, housing prices got to $480,000. So not only was that up $175,500 from the peak in June 2006, it was actually up $32,000 from the inflation-adjusted peak that had been achieved in June 2006. But interest rates were lower. Interest rates at the end of May, according to the Mortgage Bankers Association, were 5.33%. And so if we used 5.33% average loan, 90% loan to value on that median sale price, we were at $2,391 per month. So that's $202 less than was being paid in June 2006. So over that, 16-year, little over 16-year time frame, housing prices were housing cost, the amount people pay for their houses, we're still down $202. But since May, housing prices have come down. Housing prices have come down $45,000. Of course, interest rates have gone up. So let's see what happened to affordability. $435,000, 90% loan to value. At the Mortgage Banker Association's reported average loan for last week, reported 2 days ago, 7.03%. That monthly payment, $2,593. It's $2 less per month than we saw in June of 2006. It's basically exactly the same thing. $2 different per month, right? Housing prices came down, but interest rates went up, and that has caused $200 worth of additional cost for people to have to pay if they buy a house today relative to buying a house, median house, in May of this same year. Interest rates have a really big impact on affordability, and that's what's causing this volatility in the sales volume. Is people are finding it, wow, it's really expensive to buy a house now. Not because the housing price is really expensive. When people focus on the price of a house, you're focusing on the wrong thing. That does not matter for affordability. When people focus on monthly payment, that is literally what people can afford, is how much it's costing them per month. So we've now gotten to the affordability level that we had in June of 2006, 16 years ago. We're at exactly that level. Now, is that a crisis? No, there's still all sorts of ways to overcome the affordability challenges. So if you're a buyer and you're wondering, how do I overcome affordability issues? Talk to me. Talk to any other real estate agent. If they're not giving you good answers, talk to me, because there are ways to overcome affordability challenges. Now, one other comment I want to make, and that is with regard to the level of sales existing right now. So if we look at sales for single-family homes for October, 1573. We look at the number for September, 1836. We look at a little bit better number for the month of August. So that's kind of interesting. We're averaging over the past 3 months about 1,800 homes get sold in the Las Vegas Valley. Now, this is in contrast to the number of members of the Las Vegas Realtors Association, LVR, previously known as GLVAR. Approximately 18,000. That means 1/10 the number of houses sold as there are realtors in LVR. Right? There are real estate agents who are not members of LVR. They tend to be even less active, but that's 1/10. So in reality, sales transactions have two sides, a buy side and a sell side. But that means that if we doubled the number of transactions to get the two sides, we're still at 1/5 of the number of agents. What that translates to is the average real estate agent in Las Vegas right now, they're looking at 2 transactions a year, either representing a buyer or a seller. 2 transactions a year. So I point that out because most real estate agents don't actually have all that much experience. Somebody could be a real estate agent at the average level of activity. They're doing 2 transactions a year. Last year we had twice the volume, 4 transactions a year. So when you're talking to agents, it doesn't mean that, low volume alone is problematic, but it does mean a lot of real estate agents are not truly experiencing this market in terms of what it takes to buy things, what it takes to sell things. Talk to people, find out what their actual volume is, find out how much they actually know about this market. when you're talking to them before you make a hiring decision. Now, there are some agents who are incredibly active, and there are some agents who are doing absolutely nothing at all. I'm not saying that you should only go use those agents with huge volume. There are reasons maybe that's not what you want to do, but you want to make sure that people are at least experiencing enough of this market that they understand how to act and transact in this market, because you're trusting them with probably the most important, most large-scale financial investment that you have. Please reach out. At the Chong Miller Group, we help people buy and sell homes. We're really good at positioning your property. Do know sales are slow and they're going to take longer than they had been even in the early part of 2022, but we can protect your price, we can protect your equity, we can help you get your property sold. So please feel free to reach out to us, at least engage us in a conversation. It might turn out that it's really productive for you. Please smash the like button, subscribe if you've not already done so, and I look forward to seeing you in the next video. Thank you. Bye.